reverse mortgage is simply a mortgage. Nothing more, nothing less for those over the age 62 that allows them to convert a portion of their home's equity and turn it into tax-free money developed by Congress. There are no monthly mortgage payments that are required. There's no credit score requirements to qualify. You don't give up ownership or come off title to the home. It's interesting. When I was up in Boston, where I interviewed John and Wade was there, Sandy Timmerman, two of our professionals said, you know, when I first began learning about reverse mortgages, I didn't even know that you didn't give up ownership to the home. That's something we run up all the time from all types of people. Oh, Don, I wouldn't tell my clients to do that because that's that deal where you loan them the money. When they die, you take the house. I said, oh, no, I don't take the house. It's just a mortgage. Just like a mortgage you may have on your house, when you die, the mortgage gets paid off and whatever money remains passes on. And without ever having to repay more than the home is worth. So even if your home is upside down, you took out a reverse mortgage and the $200,000 you borrowed, it's now, you're 114 years old. You owe me $500,000, but your house is only worth $300,000. You're upside down. Because it's a federally insured loan, you'll never be required to repay more than the home is worth. No deficiency judgment may be taken against your heirs and or your estate. That happened in 1988. Now, most people don't know the genesis of the reverse mortgage started at the Wharton School in 1975. Dr. Jack Guttentag wrote a paper, a technical monograph or a technical brief called Financial Instruments for the Aged, where he looked at he was kind of being a futurist, which Jack was so good at, and he talked about what's going to happen in the next 20, 30, or 40 years. So the paper he wrote at the Wharton School in 1975 eventually got traction, and it was not until 1988 that it becomes part of our federal government. So the reverse mortgage has its history here, and I believe this institution has some history with the Wharton School as well. How much money can you receive from a reverse mortgage? Well, it's based on three things: the age of the youngest borrower. The older you are, the more money you're able to get. The value of the property, and the interest rate associated with the program. So we look at those three things. The older you are, the more money you get. The lower the interest rate, the more money you get. And the greater your value of your home is. A reverse mortgage must be a first mortgage. So any existing mortgages have to be paid off from the proceeds of the reverse mortgage. Don, how can the money be received? 5 ways. This will become important as we talk about the strategies for financial planning. You can get the money in a lump sum. Now, that's been throttled down over the years since last year. So we don't slide money across the table to you anymore. You can get about 70% of that if you're taking it as a cash out lump sum, because what FHA discovered were there were some culprits in our program. 10% of the people who had reverse mortgages were in technical default, meaning they weren't paying their taxes and insurance. And HUD got very concerned. Those are some of the articles that were written. And the question was, why are they in technical default? Who are the people who are doing this? Well, they found, by and large, it were those who were taking out the money in a single lump sum. I don't know what they were doing. Maybe they went down to Atlantic City or up to the somewhere and they put it all on red. And I told them, now, if you're going to do that, you got to put it on black. You can have it as a line of credit. You can have it as monthly tenure payments, meaning for as long as you live in the house, a certain amount of money is guaranteed to come to you. Term payments, which is, Don, I only need this money for 10 years. We only need it for a term, or a combination of any of those. The loan gets repaid when the last surviving borrower permanently departs the house, moves, or deceases. At that time, whatever proceeds were advanced to them gets repaid, plus whatever interest has accrued, and 100% of the remaining equity passes on to the heirs or the estate. You'd be surprised how often this is overlooked. My client, Mrs. Montini, lives in South Philadelphia. She's 75 years of age. She has a $200,000 home. She took out a reverse mortgage to pay off an existing mortgage, and she took out $100,000. So from day one, she owes me $100,000. 10 years later, she dies. Her house should be worth more than it is today. So let's say the house was worth $275,000, $300,000. In the reverse mortgage, she borrowed $100,000, but it's accruing interest. Maybe it's worth $150,000, $175,000, maybe even $200,000. And she dies. She sells the house for $300,000. She pays off $200,000, and who gets the difference? The heirs or the estate. Now, I've been saying this for 15 years, and people say, oh, you know what they forget? They forget the home typically appreciates in value. Not always, but generally it does. Well, Don, what happens if the house doesn't? Mrs. Montini owes you $200,000 and her South Philadelphia home is worth $100,000. What happened? Well, it's an FHA insured loan. It's non-recourse, which means I'm able to get the net proceeds from the sale of the house. All I get is $100,000, and there's no deficiency judgment taken against the heirs or the estate.